Introduction. The cost of capital is a fundamental concept in corporate finance, representing the minimum return a company must earn on its investments to satisfy its investors, creditors, and maintain its market value. It acts as the hurdle rate or discount rate in capital budgeting decisions. Understanding and accurately estimating the cost of capital ensures firms make investment choices that enhance shareholder wealth. Components of cost of capital. The cost of capital comprises the costs of the various sources of financing a company uses. Cost of debt, KDKD, the effective rate the company pays on its borrowed funds. Cost of equity, KKE, the return required by equity investors. Cost of preferred stock, KPS, the dividend yield required by preferred shareholders. Cost of debt. Definition. The cost of debt is the after-tax cost because interest expense is tax-deductible. KD equals RD times 1 minus T, KD equals RD times 1 minus T, where RD equals yield or interest rate on debt, TT equals corporate tax rate. Estimating cost of debt. Cost of debt can be estimated by yield to maturity, YTM, on existing bonds. Interest rates on new borrowings. Cost of equity. Definition. The cost of equity represents the return shareholders expect for investing in the company's common stock. It is generally higher than debt because equity holders bear more risk. Models to estimate. Cost of equity. Capital Asset Pricing Model, CAPM. Key equals RF plus beta times open parenthesis, RM minus RF close parenthesis. Where RFRF equals risk-free rate, e.g. government bond yield beta, equals measure of stock's volatility relative to the market, minus RF equals market risk, premium alternative model, dividend discount model, DDM. Key equals D1, P0, plus G, KE equals D1, divided by P0 plus G, where D1 equals dividend expected next year, P0 equals current stock price, GG equals growth rate of dividends. Cost of preferred stock. Preferred stockholders receive fixed dividends. The cost is KPS equals DPS, PPS, K subscript, PS equals DPS over PPS, where DPS equals preferred dividend, PPS equals market price of preferred stock. Weighted average cost of capital, WACC. WACC is the overall cost of capital weighted by the proportion of each source in the firm's capital structure. WACC equals EVKE plus DVKD times 1 minus T plus PVK PS. WACC equals frac E more phi KE plus frac D for KD 1 minus T plus frac P vi K PS on where EEDD PP or market values of equity, debt, and preferred stock. V equals E plus D plus P vi equals E plus D plus P equals total market value of financing. Key KEE, KDKD, KPSK, Thomas PSES equals costs of equity, debt, and preferred stock. WACC serves as the discount rate for evaluating investment projects. Importance of cost of capital. Helps evaluate whether investment returns exceed financing costs. Guides optimal capital structure decisions. Influences dividend policies. Impacts valuation and shareholder wealth. Factors affecting cost of capital. Market conditions, interest rates, investor risk appetite, firm's risk profile, beta, credit rating, capital structure, debt-equity mix impacts WACC, tax environment, tax rate affects after-tax cost of debt. Summary. Accurately calculating the cost of capital is vital for corporate financial decisions. It balances the risk and return expectations of all stakeholders and serves as the foundation for investment appraisal and corporate valuation.